I have been thinking a lot about the changing global landscape, and I am ready to share my thoughts. I have studied financial systems for nearly 50 years, and I have learned that the biggest market moves rarely arrive with a trumpet. I watched the 1987 crash break confidence in a matter of hours, and I watched the credit system seize in 2008 before most families understood what was happening. I also saw the oil shock after Russia moved into Ukraine, and I remember what the 1970s taught the world about energy and power. I am not here to scare you. I am here to tell you what the market is starting to price in. The crisis in front of us is not just a war story. It is the risk that a direct U.S. war with Iran turns the world's most important oil choke point into a bottleneck, and that bottleneck reaches into your grocery bill, your retirement account, and the cost of moving almost everything on Earth. The single number that should stop you cold is this. Reuters reported that global oil supplies had already shrunk by around 11 million barrels a day as of March 23rd under one Iran war scenario. That is not background noise. That is the kind of loss that changes prices, politics, and portfolios all at once. Most people are still treating this like another headline, and that is hard to believe once you see the size of the hole. If you want a calm guide while the crowd argues about yesterday's news, stay close to this page, because the next few months may reward the people who move before the talking heads catch up. Hit that button now, because I may not repeat this warning once the market starts doing the explaining for me. To understand how some investors get rich in a crisis like this, you need to understand the machine underneath the price on your screen. Most people think the oil market is the oil price the way a restaurant receipt looks like the meal. But the receipt is only the end of the story. The real meal is the well, the tanker, the pipeline, the refinery, the insurer, the bank that finances the cargo, and the trader who locks in a price months before the fuel reaches your town. By the time the evening news tells you oil is up, 3 other people in that chain have already been paid, and one of them owns the asset you should have been looking at. This is why so many ordinary investors get confused. Their advisor may show them a broad fund, an oil ETF, or a few energy names buried inside a giant basket, and it feels like exposure. But a paper claim that rolls futures every month is not the same thing as owning a business that pulls low-cost barrels out of the ground and sends cash to shareholders. A map is not the road. In a real disruption, the market starts to separate symbols on a screen from businesses with reserves, pipes, storage, and pricing power. Most people never learn that difference until the price spike is already behind them. That is the part no glossy brochure tells you. Here is the part advisors often rush past. The headline oil price is one thing, but the path from that price to your account return can be completely different. A futures fund can lose ground because it must keep replacing expiring contracts. A leveraged product can be right on direction and still hurt you through timing and decay. Meanwhile, a producer with low lifting costs, strong acreage, and patient management can turn the same price move into bigger margins, buybacks, and rising dividends. In other words, 2 investments can both wear the word energy and behave like strangers when stress arrives. That quiet mismatch ruins more portfolios than most people know. A man named Daniel comes to mind. Daniel is 59, a hospital finance director, careful with numbers, careful with risk, and the kind of person who never buys a story just because it sounds dramatic. For years, he told me the same thing. Energy spikes fade, wars cool down, and broad index funds solve most problems if you stay patient. He was not foolish. He was disciplined. But discipline without context can turn into blindness when the system itself starts to tighten. What changed his mind was not a speech. It was a stack of facts. He saw Brent shoot past $100 and briefly top 119 after the conflict widened. He read that the Strait of Hormuz handles about 20 million barrels a day, roughly 1/5 of global petroleum liquids use, and he saw that OPEC's response was only a modest increase that barely dented the gap. Then he looked at the fine print in the oil fund he owned and realized he did not own barrels, reserves, or pipelines. he owned a trading vehicle. Daniel called me late one evening and said something I will never forget. He said, "I finally understand that I bought a ticker when I thought I was buying protection." The next morning, he sold most of that fund, kept his broad market exposure smaller than before, and moved 30% of his taxable account into unleveraged shares of large integrated oil producers and pipeline operators with strong balance sheets and steady cash flow. He did not do it with excitement. He did it with relief. He looked like a man who had finally locked his front door before the storm arrived. Before we go further, let me ask you this. If you discovered tonight that your hedge was only a trading wrapper and not true ownership, would you change it this week? Or would you wait for the market to teach you the lesson at full price? Let me give you the numbers because the math does not lie. First number, in 2024, about 20 million barrels a day moved through the Strait of Hormuz, or about 1/5 of global petroleum liquids consumption. That means a serious disruption. There is not a local event. It is a world price event. Second number, Reuters reported Brent had surged more than 50% since the war began and briefly topped $119 a barrel. That means the market is not waiting for all the facts. It is already charging a penalty for uncertainty. Third number, Reuters cited an estimate that global oil supply had shrunk by around 11 million barrels a day as of March 23rd. That means there is no small patch for a large break. Fourth number, OPEC Plus agreed to add only 206,000 barrels a day for April, while analysts said spare capacity outside Saudi Arabia and the UAE was thin. That means the backup pump is small compared with the leak. Fifth number, Saudi and UAE pipeline routes can bypass only about 2.6 million barrels a day of Hormuz flows. That means even the escape valves do not come close to replacing what could get trapped. Now add one more number that tells you who feels this first. The EIA says 84% of the crude and condensate moving through Hormuz went to Asian markets. That means factories, refiners, and shipping lanes across the biggest manufacturing zone on Earth get hit first, and those costs do not stay in Asia. They travel through fertilizer, plastics, airlines, trucking, packaging, and then into the checkout line near your home. By the time the average person notices the change, the businesses that own the right assets have already seen their cash flow outlook improve. And there is a reserve story behind all of this. The United States still has the world's largest emergency oil stockpile, with capacity of 714 million barrels, though actual holdings are well below that. China is believed to have around 1.3 billion barrels in storage across strategic and commercial sites. Those stockpiles matter, but they are cushions, not cures. They can slow the first punch. They do not remove the shortage if the flow problem lasts. For investors, that means the first reaction may be softened, while the medium-term reward still goes to the owners of productive assets. So let me ask you something that may sting a little. If oil moved another $20 or $30 higher from here, would your portfolio rise with that shock, or would you just pay for it at the pump, at the store, and on your utility bill while someone else collected the upside? Now, I know exactly what some of you are thinking right now. America produces a lot of oil, so why should a war with Iran matter this much to U.S. investors? There is some truth in that. The United States is far less dependent on Gulf imports than it used to be, and domestic production is strong. But oil is priced in a world market, not a neighborhood market. If the bakery on your street has flour, but the trucks, eggs, diesel, and insurance all jump in price, breakfast still costs more. The skeptic is not wrong. The skeptic is just stopping the analysis too early. I have seen this before. People focus on where the barrel comes from and ignore how the price gets discovered. A barrel produced in Texas does not live in isolation from a tanker delayed in the Gulf, a refinery scrambling for feedstock, or an insurer rewriting risk overnight. Even if the United States imports only a modest share through that route, U.S. prices still respond to the global benchmark, to shipping stress, and to the fear premium that moves faster than the physical barrel. That is why the stock market can seem calm for a few days, while energy names quietly start to pull away from the rest of the field. Another common objection is that wars cause a quick spike and then prices fall back. That can happen, and sometimes it does. But saying that is like saying a house fire usually burns only one room. So there is no need to buy insurance. What matters is not the average case. What matters is the size of the loss if the bad case arrives. When the root at the center of the oil world is involved, even a short closure can force cargoes to wait, refineries to bid higher, and traders to pay up for supply they thought would arrive on time. If you want proof that serious money sees value in real energy assets, look at what the biggest players have done with actual cash. Exxon agreed to buy Pioneer for about $59.5 billion to secure a decade of low-cost production in the Permian. Chevron closed its roughly $55 billion deal for Hess to gain access to Guyana's Stabroek Block, a prize holding more than 11 billion barrels and described as one of the largest oil discoveries in decades. These were not marketing slogans. These were giant checks written for reserves in the ground. When organizations that large spend that much to own future barrels, the rest of the market usually notices later. And if you think that is only corporate empire building, remember that Warren Buffett's Berkshire has kept building a large stake in Occidental over time, moving toward roughly 30% ownership. Buffett does not buy stories. He buys cash flow, asset quality, and favorable odds. The people with the deepest research teams are not running from energy assets while television panels tell retail investors to stay broad and passive. They are moving closer to the source of the cash, now widen the lens. China matters here more than many Americans realize. Reuters reported that China kept building crude stockpiles early this year, with a surplus of about 1.24 million barrels a day in January and February, and estimates put its total inventories at roughly 1.3 billion barrels. That tells you two things. China knows energy security is strategic, and China can influence the floor and the ceiling of prices by deciding whether to keep buying, slow buying, or release inventory. When Beijing acts, the oil market listens. Are you waiting for the all clear from the same crowd that missed the setup, or are you willing to think one step ahead while the window is still open? That question matters more now than any target price on television. Russia matters too. Britain estimates that about 3/4 of Russia's crude is moving on shadow fleet tankers, and Europe is getting more aggressive about disrupting that network. That means one war in the Gulf can collide with another war's supply routes and make a tight market tighter. Then look at Washington. The U.S. approved more than $16.5 billion in possible arms sales to Middle East countries in March, including missiles, radars, and F-16 support. That is not the behavior of a government expecting a quick and painless reset. It is the behavior of a system preparing for longer strain. Then comes the supply chain layer that many investors still miss. Higher oil does not stop with gasoline. It flows into shipping, chemicals, fertilizers, plastics, airline fuel, trucking contracts, food transport, and factory margins across continents. When Asia faces the first squeeze and Europe pays up for replacement cargoes, U.S. companies feel it through input costs and inventory planning even before the consumer sees the final bill. Multiple giant forces are leaning in the same direction at the same time, and that kind of convergence is rarely an accident. Do not overlook insurance and freight. When ship owners fear missiles, mines, or seizures, the cargo cost is only part of the bill. Insurance premiums jump, crews demand hazard pay, routes get longer, and refiners bid harder for barrels that are already on safer water. That is why a supply shock can keep feeding prices even when no new missile is launched that day. The market is paying for risk, delay, and confusion, not only for the oil itself. Investors who own the upstream asset get paid by that tension. Everyone else pays it. Here is the question I want you to sit with tonight. Do you actually know what you own if energy prices gap higher tomorrow, or do you only own a paper product that promises exposure while someone else owns the reserves, the pipeline, the storage tanks, and the profit stream when the rules change overnight? Let me take you back to the oil embargo of 1973 and 1974. Arab oil producers cut exports during the Arab-Israeli War, and the price of oil first doubled and then quadrupled. People remember the history book version, but the real picture was more human than that. Cars sat in long lines at gas stations. Families waited, engines idling, hoping the station would still have fuel by the time they reached the pump. The claim that fuel would be there meant little when the physical supply had been interrupted. In moments like that, paper confidence and real availability stopped being the same thing. The people who held broad market paper and assumed all businesses would adjust in stride learned a hard lesson. Businesses with heavy fuel costs, weak pricing power, or too much debt suffered when the input cost shock spread through the economy. But those who owned real energy equity, especially companies with reserves and production, held something the system suddenly needed more than ever. They did not need a perfect chart. They owned the cash machine attached to the shortage. That does not mean every oil stock soared every day. It means the balance of power moved toward the owner of the scarce asset and away from the owner of the generic promise. That old episode also showed another truth. Nations with stockpiles and direct control over supply had room to maneuver. Ordinary people with only paper assumptions had lines, rationing, and inflation. I am not telling you that history repeats line for line. I am telling you that market structure repeats, human behavior repeats, and the gap between real assets and paper comfort opens fast when trust meets shortage. The same shape is forming again now right in front of us, and most people will not call it obvious until it is already expensive. Go back and study the photographs from that era, and you will see the whole lesson. The people in line had money in their pockets, cars in their driveways, and trust in the system, yet they still could not buy what the economy needed on demand. Scarcity does not ask whether you feel prepared. It asks whether the supply exists and who controls it. That is why real equity in scarce energy assets behaves so differently from paper promises tied to businesses that only consumed fuel. When the chain breaks, the owner of the source lives in a different world from the person waiting at the end of the line. So what happens next? The first possibility is the mild case. The war stays hot enough to keep risk alive, but shipping is only partly disrupted, and emergency releases blunt the price spike. Oil stays elevated, inflation stays sticky, and the broad market finds it harder to pretend rate cuts solve everything. In that world, unleveraged ownership of cash-rich integrated oil producers and pipeline operators still works because higher prices and tighter supply keep their earnings, dividends, and buybacks supported while much of the market struggles with rising costs. The second possibility is the middle case. Transit through Hormuz remains impaired for longer than officials first suggest. Refineries scramble for supply, and Brent lives in a range that keeps corporate planners nervous and consumers angry. In that world, recession talk grows, transport costs spread, and many ordinary stocks get squeezed between weaker demand and higher input costs. Yet the same position still works because businesses that own low-cost production, storage, and essential energy links are selling into a tighter market while others are paying up just to keep operating. The third possibility is the hard case. The conflict widens, facilities are damaged, more cargoes go missing, and price spikes become violent enough to force government action, panic hedging, and emergency policy moves. In that world, almost every portfolio that looked balanced on paper starts to feel fragile because correlation rises and liquidity gets thin in the wrong places. The same position still works best of the realistic choices because direct ownership of strong energy producers and pipeline firms is tied to the thing the world suddenly cannot get enough of. Mild, moderate, or severe, the clear action is the same. Own the businesses closest to the barrel, not the people standing downstream from it. Can you name the exact companies in your account that would benefit if oil stayed higher for 6 months Or are you still hoping a broad index will magically sort this out for you? Hope is not a strategy when the cost shock is the story. Here is what I would do this week. First, understand what you currently own. Pull up every fund, every retirement holding, and every so-called inflation hedge in your accounts and ask one hard question. Does this position actually benefit if oil stays high, or does it only sound like it should? Read the fund summary. Look for leverage, futures roll costs, and how much real energy exposure is truly there. If you cannot explain the position to a bright teenager in 2 sentences, you do not understand it well enough for a crisis. Second, move toward the safest form of the relevant asset. In this case, that means direct, unleveraged ownership of financially strong integrated oil producers and pipeline operators, or a plain unleveraged fund built around those businesses rather than options, triple levered products, or trading vehicles that bleed from structure. You want low debt, solid free cash flow, disciplined management, and assets that still make money even if oil cools down from a spike. The goal is not to gamble on the wildest outcome. The goal is to own durable cash flow attached to a scarce input the world still needs every day. Third, choose one signal and watch it daily. My favorite is a simple trio: Brent crude, tanker traffic through the Strait of Hormuz, and whether the disruption starts to overwhelm the small spare response from major producers. If Brent holds above the level that existed before the conflict widened, if ship delays persist, and if the market keeps shrugging at small output increases, the message is clear: the problem is not solved. You do not need 10 dashboards. You need one clean read on whether the choke point is easing or tightening. Fourth, act before the crowd is forced to act. The reason is time sensitive. Once supply damage shows up in official data, once analysts lift target prices together, and once morning television starts calling energy a safe haven, the easy part of the repricing is usually over. Markets pay the highest rewards to people who prepare during doubt, not to people who arrive after certainty. Waiting for perfect clarity in a geopolitical oil shock is like waiting to buy flood insurance after the water reaches the stairs. By then, the price is different, the choices are fewer, and your emotions are louder than your judgment. I would also remember that institutions move in stages. First, they dismiss, then they hedge, then they chase. By the time pension committees, model portfolios, and large advisors all decide they need more energy exposure, the cheap entry point is usually passed. That is why patience and speed must work together here. You do not need to rush blindly, but you do need to act before consensus turns this from a warning into a crowded trade. Fifth, prepare yourself for turbulence, both emotional and financial. Even a good position will not move in a straight line. You may buy and then watch headlines claim peace is near. You may see a 2-day drop that tempts you to doubt everything. So size the position so you can live with the swings, keep cash for ordinary life, and decide in advance what would make you add, hold, or reduce. The point of preparation is not to become fearless. It is to remove panic from the process before panic arrives. One more question before you leave this plan behind. If your account statement arrived today with every holding listed in plain terms, how many lines would make you safer if energy stayed high, and how many would quietly bleed from the same shock you say you are worried about? The answer should guide your next trade, not your fear. And let me ask one more thing before we go further. If the market opened Monday with oil sharply higher and the rest of your portfolio sagging, would you feel protected by what you own? Or would you find out in real time that comfort and preparedness are not the same thing? One narrow waterway can move the whole world's price. A supply shock never stays where it first begins. Insurance costs rise before the public sees scarcity. Shipping delays become inflation long before politicians admit it. Broad funds hide weakness when the pressure is low. Real assets reveal their value when the pressure climbs. Paper exposure and true ownership are not twins. Big institutions are buying reserves, not clever narratives. China is stockpiling. Russia is rerouting. Washington is arming for duration. The market is whispering before it decides to shout. If you ignore this, the bill may still find you through everything else you buy. If you prepare now, you do not need a perfect forecast, only a position built for stress. When the world rediscovers the price of energy, the people who own the barrel stop asking for permission. Energy is the foundation beneath the headline economy. War changes supply. Supply changes price. Price changes politics. Politics changes markets. The investor who understands that chain does not need to predict every battle map. He only needs to know where the cash will flow when the system tightens. Quiet preparation beats loud prediction. Ownership beats opinion. Structure beats hope. You do not need to become a war expert to see what matters here. You need to recognize that energy is not a side issue in the global economy. It is the hidden input inside transport, food, manufacturing, heating, chemicals, packaging, and national power. When that input is threatened at the choke point that carries about a fifth of world petroleum use, markets do not wait for politicians to settle their arguments. They start repricing risk. That repricing does not reward everyone. It rewards the owners of scarce productive assets, the people who stayed unleveraged, and the investors who understood the difference between a paper promise and a cash-flowing business. If you remember nothing else, remember this. Wars create fear for most people, but they create pricing power for the owner of what the world still must consume. That is why calm preparation today can do more for your future than panic ever will. Markets rarely send that lesson with a label before the cost arrives. So who in your life still thinks this is only foreign news and not a direct hit to their savings, their bills, and their future buying power? Send this to them while there is still time to think clearly. And if you want the full breakdown of how I would position for what may come next, everything you need is waiting in the link below.